The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Let's get across what is going on, and it's the focus very much on that announcement from Donald Trump that a ceasefire is due to take effect in the next few hours between Israel and Iran in the Middle East. Yet to get confirmation from those two countries, but they've actually continued to exchange some missiles in the meantime. And as a result, we have seen oil take a big tumble, initially sliding 9%, falling another 4% in after-hours trade in the US, but also potentially investors still a little cautious about piling into those risk assets. Nonetheless, we have seen the market begin high. Let's get to our local market and what we are witnessing there. Well, just taking a look, already up close to 0.9%, very much risk on the local market. Also seeing those SPY futures in the States up as well. Bearing in mind, look, also got to focus on some of those travel stocks at the moment, which have been affected by the Middle East. Certainly what's transpired overnight this after Iran launched a strike against a US base in Qatar, which prompted Qatar to close its airspace. US President Donald Trump, as I mentioned, since then announcing a ceasefire, yet to be confirmed. In the meantime, airlines including Qantas have had flights diverted or cancelled. Virgin Australia, which relists on the ASX today, also has been affected as it operates flights in partnership with Qatar. And there we can see some of those stocks on the move. Let's get some analysis then of what we're likely to see in today's trade. Chris Weston joining us from Pepperstone. Chris, welcome. Okay, so that big news overnight. Initially, it was what was regarded as a fairly muted response or retaliatory response from Iran in striking, or attempting to strike those US air bases in the Middle East. Since then, of course, we've had that news, Donald Trump announcing a ceasefire. How's that played on the markets, particularly that move in oil?
Yeah, like the move in oil was absolutely prolific. We saw above $81 on the open, on the futures open, and then, the sellers just came straight in from the back. Now, I'm putting this down to, one, the fact that the market was probably short-term long, but also in the options market, there had been a huge amount of tail risk hedging coming through. We've seen that in 5 Delta implied call of volatility trading up to a 95 vol difference relative to put or downside volatility. So the market was well hedged against tail risks, those tail risks being potential infrastructure impact on their oil facilities and a loss of Iran's 1.5 million barrels of exports a day, and then obviously the Strait of Hormuz, which I think most people saw that as a very low probability of a disruption, but that's continued to people were hedging against that, and I think as the new we got the weekend news coming through, we were obviously anticipating a retaliatory response. People did start unwinding some of those extreme hedges. And that pushed up that trade pushed down front month crude futures, and that's what we can see from this chart, which is actually our spot contract, which we use the futures and we make a fair value from that, or take out the fair value. But you can just see the magnitude of the selling as this came on. I mean, it was prolific, and as I say, the market was well hedged. As those hedges were reduced, people sold volatility. That pushed down the spot price, or the front month crude futures price. And then, of course, we got the news of the actual actions that took place, and Iran have struck the Qatari, or at least attempted to strike the Qatari bases, and also what we've been seeing in terms of US bases in Iraq as well. And there's been no loss of military personnel. Obviously great to see, and obviously there's been no real major damage being caused, and people saw that as a bit of a lightweight response. Again, that sort of pushed down volatility, and that's where we are at the moment. So we've got the ceasefire. We'll have to see how that sort of goes in the short term, but I think what we've seen from the crude pricing here is that the market is saying the chance of an impact to infrastructure and a loss of barrels from Iran has obviously been mitigated. Any sort of misfound belief that we were going to see the Strait of Hormuz operating less efficiently has obviously been taken out the price now, and those hedges have been unwound. So a huge move down. But really, if you were to go in and have a look at the equity move, it was Brent that was at the epicenter of markets. As the Brent price was selling off, we saw S&P futures rallying. Gold was quite interesting. That saw a few sellers. It's been a bit of a whippy ride recently, but people have unwound some of those geopolitical hedges in gold. And we've seen a big reversal coming back higher in Aussie dollar and euro dollar as well. So I'm putting down to the market getting a clear sense that we've moved on from this idea that we're going to see Iranian barrels being impacted, and also some of those tail risks of the Straits of Hormuz being shuttered is obviously off the table. We only put that down to about a 0 to 5% probability anyway, but obviously people had hedged themselves, and that's what we're seeing in the crude price there, which has collapsed. So good news for financial markets, and equities can breathe a sigh of relief here.
Well, in fact, and that's exactly what they're doing this morning. Just taking a look at the local market, Chris. So it is rallying as you would expect in all sectors, aside from, predictably, gold and
energy.
Also energy.
No surprises there. I mean, that's exactly what we saw on the S&P as well, with all sectors doing well, and it was only energy. But fair. I mean, that's not going to surprise you when I say it's the energy sector's done quite well recently as people got long and bought volatility around that, and obviously following what we've been seeing in the Brent and WTI price. So it's no surprise people taking a bit off, and then they're going into banks. Banks look pretty good at the moment. As you can see there, we've got the S&P chart now. That's been trading in this kind of defined range of 60.50 down to 59.17. People have really just been playing that range, looking for a bit of clarity to play through. Now we've seen this morning, our time this morning, that has now broken out to the top side. There's a sort of a saying in markets that you sell to the sound of trumpets and buy to the sound of cannons, and I think people were happy to buy risk to the sound of trumpets because it's been a buy the dip playing through. But now we've got this resolution playing through. It's pretty clear that the US is not going to be involved in a prolonged military involvement here. And the crude price is not going to stay $100 for a period of time, which of course was the real risk to markets here. And that's not going to happen. So equities have rejoiced. Banks look pretty good. I like quite being long banks at the moment because we are seeing not just because of what we're seeing in the supplementary lending ratios, the SLRs, for example, that's benefiting the treasury market, but also it's benefiting banks. But also you're seeing a calmer volatility surface, and effectively that what that's doing is that's propelling corporate activity. We are seeing a big pickup in ECM activity in the banks in the US at the moment. So Citigroup, JP Morgan, they all look good. The XLF's moving a bit higher. So I like banks. I think Nvidia and tech still looks good. But we're seeing a breakout now. So we're not a million miles away from all-time highs. I feel we get there. I think that's where the probability of risk sits at the moment.
Chris, also on Wall Street, investors very much buoyed by what they heard from Fed members too, Michelle Bowman in particular, talking about the prospect of a rate cut next month.
Yeah, you make a great point. I mean, we sort of go back to last week where we saw Christopher Waller, who is one of the more sort of interesting and more, one of the characters that we really listen to. He is, if you look at the sort of the hawk-dove spectrum within the Fed's ranks, he is the most dovish. And so it's no surprise when we heard from him on Friday suggesting that the Fed should be overlooking the inflationary nature of tariffs and cutting rates sooner. Of course, the cynic in all of us said, well, the guy's going for the Fed job in May of next year, and he's obviously trying to appeal to Trump's instincts by being so dovish. But then that was followed up by comments fairly similar from Mary Daly. And then we've also heard, as you say, from Bowman, who is somewhat more on the hawkish side. So the fact that she's looking for rate cuts sooner rather than later is quite interesting. So for me, you can look at the US situation at the moment. Labour market's obviously still strong. The unemployment rate's at 4.1%. Non-farm payrolls growth is coming down, but it's still at a healthy level. But continuing claims are there. People saying they're finding it hard to get a job are increasing. All the regional surveys are showing sort of some signs that hiring is falling down. And the housing market is noticeably weak at the moment. So look, there are some factors, especially when you look at realised inflation, which we're going to see on Friday with the core PCE deflator, likely to come in at 2.6% year on year, which would actually take the 3-month annualised rate to a lowly 1.6%. So if you look at all those factors in isolation, you could say the Fed, if it wasn't for tariffs, should be cutting rates sooner rather than later. So the Fed just need to be in the position to feel that tariff situation is not going to impact them, and they can cut. So my base case, my own personal base case, is that the Fed cut rates in September, but they'll set up a move in the July meeting. There is no August meeting, so they set up the market for a rate cut in July. It happens in September, and maybe we get another one by the end of the year. But yeah, if we have a look at the US dollar, I mean, that's been a factor. I mean, we did see some initial strength yesterday in the US dollar, and that's a S&P. I think that's the US 500. But if we're talking about the euro and the dollar index, the dollar index did have a bit of a move up to the 50-day moving average yesterday, and then we've seen sellers coming through. That was the right trade, but now euro dollar is breaking out above 116, and Aussie dollars had a nice reversal off those lows. So maybe people are saying that the Fed are going to be looking to cut rates sooner rather than later. Maybe these comments from Bowman, from Waller are quite interesting. And as we've continued to unwind some of these geopolitical hedges, not that the US dollar was a really strong geopolitical hedge anyway. I think the euro is the currency du jour at the moment. Euro yen is breaking out. Euro sterling's been strong for a long period of time, but the euro is where you need to be looking at this week, because France are really pushing the rest of the monetary union into shared budgets. That's positive. And then you've also got Germany expected to announce their 2026 fiscal plans for next year, obviously. And that's obviously been a big tailwind for the euro as well. So euro dollar above 116. Aussie's had a bit of a nice reversal, was in line with what we've been seeing in risk there as well. And dollar yen's moved a little bit lower, and because the yen has been under a bit of pressure because it is a massive energy importer. So for me, watching that core PCE number. Does it come out 2.6%, 0.1%, 1 month a month? That would play into my playbook that in the July meeting, they will be announcing that they're likely to cut rates going forward. They won't cut rates there, but I think they'll pre-announce that's where they're looking.
Chris, great analysis. Thanks for joining us on Pepperstone. Enjoy your day.
Good on you, mate. Thanks a lot.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.